You made your credit card payment this month, $847. Felt responsible, right? You're tackling that debt. Here's what they don't tell you. Only $47 of that payment actually reduced your debt. $800 went straight to interest, to the bank. You just worked an entire week and almost all of it went to making a bank richer while your debt barely moved. Welcome to the credit card trap, the most profitable scam in American banking, and you're in it. Meet Sarah. She's 29, makes $65,000 a year, has $8,500 in credit card debt spread across 3 cards. Nothing crazy. She's not reckless. A car repair here, a medical bill there, a few months when expenses exceeded income. It happens. She pays $250 per month across all 3 cards, more than the minimums. She's being responsible. Here's her reality. At her current payment rate, it would take her 9 years to pay off that debt. 9 years! And she'll pay $6,300 in interest on top of the original $8,500. She'll pay almost double what she borrowed. And that's if she never uses the cards again. If she adds even $50 a month, one dinner out, one emergency, she'll never escape. This isn't financial illiteracy. This is engineering. The credit card system is designed from the ground up to keep you in debt as long as possible while extracting maximum profit. And it starts with the minimum payment. Banks don't just calculate a random minimum payment, they engineer it. That minimum payment is mathematically designed to cover the interest and barely touch the principal. They've run the numbers. They know exactly what payment keeps you trapped longest while making you feel like you're making progress. Let's break down Sarah's biggest card, $8,500 at 22% APR. Her minimum payment is $170. Sounds reasonable. Here's what that $170 actually is. $156 goes to interest. $14 goes to principal. $14. After a month of work, after scraping together that payment, her debt went down by $14. At that rate, it would take her 47 years to pay off. 47 years! But it gets worse. Every time she uses that card, even for $20, the interest starts compounding immediately on that $20. Meanwhile, her payment gets allocated to the oldest debt first, which means that new $20 charge sits there accumulating interest at 22% while she slowly pays down old charges. The system is rigged so new debt piles up faster than old debt goes away. And then there's the trap inside the trap, the credit limit increase. Sarah makes her payments on time. She's a good customer. So after a year, the bank increases her limit from $5,000 to $8,000. They call it a reward. It's not. It's a bait. Because now Sarah has room to spend. And when life happens, and life always happens, she uses that room. The debt goes up, the minimum payment goes up. But the bank just locked her in for another decade. Here's what makes this truly evil. The banks know exactly who they're targeting. They know that people making $50,000 to $75,000 a year are the sweet spot, earning enough to make payments forever, not earning enough to pay it off. They market aggressively to college students with no income. They offer rewards points that make people feel like they're winning when they're actually losing. They make it incredibly easy to spend and incredibly hard to pay off. And the profits? American banks made over $120 billion in credit card interest in 2025. $120 billion! That's not a business. That's a system of extraction. They're not lending you money hoping you pay it back. They're lending you money hoping you don't. So how did we get here? Credit cards weren't always like this. In the 1980s, the average credit card interest rate was around 8%. Think about that. 8%. Then, financial deregulation happened. States started removing their usury laws. Those were the old laws that put a cap on how much interest the lender could charge. Banks, seeing an opportunity, moved their credit card operations to the states with no limits at all. South Dakota, Delaware. Suddenly, there was no ceiling. Interest rates shot up to 20, 25, even 30%, and they've stayed there ever since. But the interest rate is only part of the story. Let's talk about the fees. Late payment fee? That can be up to $40. Go over your limit? Another $40. Need a cash advance? That'll be 5% of the amount you take out, and the interest starts ticking the second you get the cash, not after some grace period. Using your card abroad? That's a 3% foreign transaction fee on every single purchase. All in all, they've engineered at least 12 different ways to pull money from your pocket that have nothing to do with your initial purchase. And here's the most brilliant, deceptive part, the psychological trick. They market these cards as tools of freedom, rewards points, cash back, travel perks. They make you feel smart, like you're hacking the system by using them. But here's the hard truth. The average person with a rewards card spends 23% more than they would if they were using cash or a debit card. 23%. Those rewards are bait, designed to make you spend more. The math almost never works in your favor unless you pay your balance in full every single month, and 60% of people don't. Let's go back to our example of Sarah. She's paying 22% interest on her debt. If she stopped using her cards today and just kept making her current payments, she would spend $6,300 in interest alone over the next 9 years. That's a small car. But here's the crucial thing most people don't know. That debt is negotiable. You have power here. First, there's the debt avalanche method. Instead of paying a little extra on all your cards, you pay the absolute minimum on everything except the one with the highest interest rate. You throw every extra dollar you can find at that single card. Why? Because that's the one that's eating you alive with interest. Once it's paid off, you take that entire payment and roll it over to the next highest rate card. The psychological win of completely eliminating a card one by one is incredibly motivating. Second, balance transfer cards. If Sarah has decent credit, she could move her $8,500 to a new card with a 0% introductory APR for 12, maybe 18 months, no interest for over a year. If she keeps paying her $250 a month, she'd pay off $3,000 of pure principal in that time. $0 would go to interest. That's $3,000 saved. Third, and this is a big one, you can negotiate. Call your credit card company. Tell them you're struggling and you're exploring your options. Ask for a lower APR. They would rather lower your rate and keep you as a paying customer than have you default and get nothing. If you have a decent history of payments, they will often cut your rate by 5 to 8%. That can save you thousands. Fourth, and this is the hardest but most important step, stop using the cards. This sounds obvious, but the system is designed to keep you swiping. You have to break the cycle. Cut them up, freeze them in a block of ice. You cannot pay off debt while you are simultaneously adding to it. It is mathematically impossible. Here's the thing the banks don't want you to know. Once you're out, stay out. Credit cards are not tools of wealth, they're tools of extraction. Yes, wealthy people use them, but they pay them off every month without fail. They use the system doesn't use them. For most people, these cards are a carefully constructed trap. It's real, it's engineered, it's profitable for them and devastating for you, but it is not inescapable. You can get out. The debt avalanche, balance transfers, negotiation, stop using them. These strategies work. It just requires seeing the trap for what it is first. Now, go break free.